inform you that we view this quarter as a good comeback quarter for us. We could regain some of our revenues, and in these uncertain, difficult times, our team has done a great job in regaining some of our margins. Also on the Capex areas, we've progressed well, and so all in all, a very on a positive note, I said that from here on the journey looks to be great. For more details, I'm going to request my colleague Mr. Nathu, our CFO, to take this forward. Thank you, Mr. Rathi, for opening remarks. Archit, is this clear?
Yes, sir. You're audible, sir.
Yeah.
Nirav, can you please confirm the same? Thank you.
Yes, sir, it's audible.
Yeah. Thank you, Mr. Rathi, for opening remarks. Thank you, Archit and Dolat Capital for hosting our earning call. Good evening, ladies and gentlemen. Welcome to Sudarshan's Q3 FY22 earning conference call. Our investor presentation has been uploaded on the stock exchanges for your ready reference. I would like to take you through the financial highlights for this quarter. On a consolidated basis, total income from operations stood at rupees 602 crore as compared to rupees 506 crore for the same period last year, reporting a growth of 19% year-on-year. This was the highest quarterly sales where we crossed a rupees 600 crore mark for the first time. Ebitda for the quarter stood at rupees 74 crore as compared to rupees 80 crore in Q3 FY21. Ebitda margin stood at 12.3% as compared to 15.7% over the same period last year. Profit after tax stood at rupees 36 crore as compared to rupees 43 crore for the same period last year. On a 9-month basis, total income from operations is at rupees 1,574 crore versus 1,288 crore in the same period last year, a growth of 22%. Ebitda for the 9 months is at rupees 189 crore versus rupees 200 crore last year. Ebitda margin is at 12% versus 15.6% over the same period last year. PAT for the 9 months is at rupees 85 crore versus rupees 92 crore in the last year. Now going into the details of our pigment business. For the quarter, income from operations stood at rupees 560 crore, a growth of 17% year-on-year. Ebitda for the quarter is at rupees 77 crore as compared to rupees 78 crore in Q3 FY21. Ebitda margin stood at 13.7% as compared to 16.3% over the same period last year. However, on a sequential basis, Ebitda margins have improved by 2.5%. Price pass-through, volume growth, and overhead cost optimization have helped in sequential improvement versus Q2 FY22. Demand momentum in the domestic market continues, which we had seen from the middle of Q2. Domestic sales for the quarter stood at rupees 306 crore as compared to rupees 261 crore in the same period last year, growth of 17% year-on-year. Sales in the coating segment continued to do well, and we saw higher demand coming in the ink segment, which was softer during Q2. We did also see improvement in the demand from plastic segment. Export for the quarter is at rupees 254 crore as compared to rupees 216 crore last year, a growth of 17%. Exports have grown 22% sequentially over Q2 FY22. We gained volume in the international geographies with easing of pressure due to aggressive pricing approach by some of the competitors. Specialty pigment sales stood at rupees 375 crore as compared to rupees 329 crore for the previous year, same quarter, up by 14% year-on-year. Non-specialty sale for the quarter is at rupees 185 crore as compared to rupees 148 crore for the same period, growth of 25% year-on-year. Gross margin for the quarter stood at rupees 41.6% as compared to 43.2% for the same period last year. We see input cost pressure continuing in the basic chemicals and the intermediate prices. Our endeavor is to pass majority of the cost increases to the customer. However, we did calibrate pricing decisions selectively to gain volume. Input cost increases normally have a lag effect of a quarter in full pass-through to the customer. Apart from raw material cost increases, we continue to see energy and logistic costs at an elevated level. Coal prices are still above 200% of the levels seen in the last year, Q4 FY21. This is pushing up the manufacturing cost. The challenges in the logistic area are continuing and leading to freight cost escalation of 3 to 4 times. With the direct as well as indirect material cost pressures lingering, we will have to continue with the selling price increases, taking calibrated approach to balance on volume growth. Now, coming to our Capex project, which is our search for the future growth. We completed commercialization of Capex project worth rupees 160 crore from ongoing Capex plan of 750 crore in this year, YTD December. We expect total capitalization during FY22 will be at rupees 300 crore. This will include Capex project in the new molecules as well as capacity addition in the existing pigments as well as the infrastructure related Capex. We continue to see gradual ramp up for our yellow pigment products. Capex projects to launch new products under high performance pigment and in the inorganic high performance pigment have progressed well, and we expect commercialization during Q4 FY22. Our manufacturing plant continues to operate in line with various directives of the government during the last quarter. We remain watchful of actions taken at various state level following third wave of COVID-19. We continue to deploy and practice necessary safety precautions regularly to ensure continuity and uninterrupted functioning of our plant, with safety and welfare of our employees being of utmost importance. We look forward to continuing our growth journey and delivering value to all our stakeholders. With this, we now open the floor for question and answer session. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, you may press star and 1 to ask a question. The first question is from the line of Sanjay Jain from ICICI Securities. Please go ahead.
Thank you. Good afternoon to all. Few questions from my side. First, Nakuji, in your opening statement, you spoke about aggressive pricing in the international market. Can you help us elaborate to understand, is it China which is doing pricing aggression? We thought that the logistic issue has significantly come down the competitive intensity. But your opening remark actually indicate a very different scenario. Hello?
Can you hear us?
Yes.
Yeah, I can hear.
Yeah, 1 second, yeah.
Sanjay, may I request you to self-mute your line from your side, please?
Sure.
Thank you.
Yes, this is Rajesh. I think what this is Rajesh Bhatti. What Nakuji was referring to is saying that as we saw volume, a little bit of volume shrinkages in the market because of COVID, the market scenario, we saw competitors to be very more aggressive in the quarter, in that quarter, and as the consolidation on some of the M&As were going on, we saw some activities which were a little more aggressive. I think that's the only context I think what he meant.
So we don't see any risk to passing on the inflation. That is that the line to be read from that statement?
No, we don't see the risk in passing on the prices. Like as I mentioned, that we are taking we are passing on this raw material price increase, and which has been also evident. So we will continue to do that.
Okay, thank you. The second thing, we spoke about an acceleration in the high-performance pigment starting Q4 from the new product launches and their acceptance. What are we seeing and where are the areas we are now getting that kind of an encouraging result to see that the Q4 could be much, much better?
Yeah. So, sir, as we are progressing, as we said, we are progressing well on the Capexes. We are gradually putting to use all the Capexes which we were able to do. One major molecule we've been, kind of put to use. We put to use now, and we expect the other Capexes to get completed either by Q4 and some may spill over to Q1. So that's a great, that's where we look at. Also from a progress on some of the products which we've launched previously, we are seeing a good progress and response on them. So we should see a good gradual ramp up.
Got it. Couple of questions on the current result. If we see your result, revenue growth looks solid, over 27% YOY. How much of it is because of the price increase which was taken from the RM inflation? And if we were to adjust for that, what is that adjusted normalized growth we are looking at?
Hello. Sir, Nilkant here. So as we also mentioned that in the earlier call, so we are also looking at the kind of disclosure which we can get, which we can do as a part of our IR. Currently, what we are reporting is the value growth. I think your question is more from also volume. So that number.
Not specifically, because we would have sold high performance product. Our specialty mix has gone up. So I don't think I meant volume. I meant if we were to remove the inflation, which was purely on account of raw material, should the growth be upwards of 20% for us?
So, sir, I think there has been, like you are indicating, the mix for us has been better. I mean, we're selling more high performance pigments, we're selling more effects, etc. So the mix change has been positive, and there's been a volume growth too. So all in all, I think both these effects have had a good result for us. On more specific details, we will look at how to disclose this in more detail. Right?
Got it. Just from the new revenue which we have disclosed, that the new capacity which we are adding could potentially bring in an additional revenue of 15 billion. Can you try and help us understand how much of it will be new product, how much of it is from the existing product? Some color on that.
So 1,500 will be the full potential in the next 3 years. That's what we are saying, right?
Right. I understand that. I just wanted to understand out of that 1,500,
yes,
how will the mix be?
So the mix, just back of the envelope calculation, just give us a second.
Yeah.
So approximately 600 crores will be new products. The rest will be enhancing our, not completely blockbuster new products, but enhancing the range, right? Some is volume extension mixes. But blockbuster new products will be about 600 crores, I would say.
And the remaining will be the normal launches or a facelift or some variation or a modification plus existing product.
And also obviously volume, we've gained substantial volumes on some molecules, etc., right? So volume
correct.
Yes. Yeah.
So capacity enhancement.
Yes.
One last bit of question, and then I'll get back to the queue. What is the margin difference? Or first, let me understand. When we say specialty, so what does that include when we say specialty in our presentation?
I think the presentation should include. Can Amay or Natuji, can you all?
Amay decided. So the specialty pigment consists of azo pigment, high performance pigment, cosmetics, and the solvent dye green.
Okay. Got it. Just wanted to understand from the margin perspective. Okay. I know we don't disclose margin independently, and I'm not looking for that information. I just wanted to understand what is the margin difference between the non-specialty and specialty pigment. Say if we do say 100% margin in one, another 120. What is the ratio of a non-specialty pigment and a specialty pigment? I'm not looking at the absolute margin. I just wanted to see what does the premiumization mean from the margin perspective. Ratio will do.
So supposing your normal classical non-specialized would be X, then the margins on this would be about 1.5X.
Oh, so it's a 50% higher margin business for us.
No, what I'm saying is the margin is 50% higher, right? So,
that's it. So if I say 10% margin, in another you allow 15% margin, right? That's what you're telling.
Exactly.
Oh, that's quite a meaningful margin accretion if we are able to pull that up. Great, sir. Thanks for answering all the questions, and best of luck for the coming quarters.
Thank
you, sir.
The next question is from the line of Ankur Periwal from Axis Capital Limited. Please go ahead.
Hi, sir. Thanks for the opportunity. First question, on the RM inflation and on the gross margin front. Your comments in terms of by when do you expect a full pass-through? As I understand, and as you mentioned that, there is some bit of pass-through which we have already done in this quarter. But then there was a comment on the overall competitive intensity, etc., which would have restricted some bit of this pass-through. So just want to understand from your perspective, this 40% odd gross margin that we are looking at currently versus maybe a 43-44%, when we can see a normalization of these numbers.
Good evening, sir. Rajesh here.
Yes.
So there are two parts to it, sir. The challenge, there are two challenges. I think one challenge is that there has been a continuous increase, right? So we do an increase, then there has been more increase. In fact, Q4 we've seen some more increases, right? Which we are passing it on. The second piece here is, sir, we are trying to get we're passing on the absolute increases, right? So in the absolute increases, sometimes, you are not going to see the same percentage changes, right? So we are hoping that as soon as the inflammatory market kind of starts reducing, we should see percentages going to normal. However, given the current scenario, we don't see the current raw material prices kind of moving, at least for Q4 and also Q4 definitely. Not sure about Q1 yet, but Q4 we're waiting for China to also start and look at all the commodities.
Sure, sir. That's helpful. And earlier, you had also mentioned the cost inflation across the energy costs, power, logistics, etc. So when you are saying you are passing through the inflation, apart from RM, are we also renegotiating on these energy costs, etc., or these will be eventually borne by us only?
Sir, we of course can pass on the energy cost also, but it's a little difficult to pass on the full energy cost increases, right? Because it's an indirect cost, right? So it becomes a little tougher on those passing on those increases. So our endeavor is to pass that on, right? So I would say the success rate would be, and that's where we are seeing a success rate would be not passing on the 100% energy price increases, but somewhere to the tune of, Nathuji would say 70% or something like that, 70.
Okay. Fair enough. Sir, another thing on the new product launches, we were expecting large part of the Capex to be completed within this quarter, probably some spillovers were in Q1. What sort of time frame, would you look at when you see the incremental revenue contribution coming from these new Capex, new products? Where I'm coming from is there will be some bit of, delays on, not exactly delays, but time lag for product approvals, etc. So do we see an immediate sort of jump here, considering that we would have piloted or seeded the newer products for customer approval already? Or it will take some time and maybe after a few quarters only that benefit should be visible?
I would say a few quarters, sir, because there are two challenges in this. One is, while we are as we stabilize our the raw material costs which we have bought are on a peak, right? Whereas the market, since we have been new in this product lines, we have to buy the market products now, but at the peak. Whereas some of our competitors would have covered these raw materials much earlier. So we are looking at a point where we are at a high. So that's the reason where we feel that getting the whole benefit not at the revenue but at the Ebitda level would take some time.
Sure, sir. And we will be largely replacing who here? The European players or the Chinese players with these new products?
So mostly European. It's a mix: European, Indian, Chinese, right? But mainly European.
Sure, sir. And last question, if I may squeeze in. You had earlier mentioned, some bit of initiatives on the backward integration as well, which can sort of, restrict this RM issues for us in the near future. Any plans for this, given that large part of our, product led expansion, the Capex plans, should largely be behind in the next couple of quarters? So any thoughts there on the backward integration side?
There are on backward integration, the board would finally take a call in March when they approve the budget for next year. From a technology perspective, we are ready. Even pilot plant, we've done several trials, right? It's a question of, as you're aware, due to COVID and several other reasons, these other CapExes were delayed. So that's the reason why, we've been holding on to some of these other CapExes. But the board would take a view. When we present the final budgets in March. Then.
Okay. Great, sir. Thanks a lot for your answers and all the best. Thank you.
Thank you.
Thank you. The next question is from the line of Abhijit Akella from IIFL Securities. Please go ahead.
Yeah. Good afternoon. Thank you so much for taking my questions. Just a couple of clarifications. One is on the Omicron impact. We've seen some signs of slowdown in India's activity across various sectors because of the third wave. So any impact that is visible to you across your key end-use segments for the fourth quarter of FY22?
So I think India we were seeing a good pickup as quarter. January we are seeing a slight slowdown, especially in the plastics area. We've seen a little bit of a slowdown. but we are hoping that February, March, things will bounce back.
Got it. Thank you. And the other thing I just wanted to clarify is the Capex slide in the presentation this time talks about 300 crores of target for FY22. Last quarter it was about 400 crores in the presentation. So just wondering if about 100 crores is being pushed back to FY23 now.
Yeah. Yes, sir. So we expect a few Capexes to roll into Q1, and that's where the estimate of 300 crores.
Understood. And one last quick thing. On the tax rate, we've been clocking about 25% on the P&L effective tax rate. Is that the rate we should expect to continue, sir, going forward?
Yes, we expect to continue this 25% tax rate. We have shifted to the new tax regime last year, so we expect that this rate should continue.
Okay. Thank you so much and wish you all the best.
Thank you, sir. Thanks, sir.
Thank you. The next question is from the line of Rohit Nagraj from Emkay Global. Please go ahead.
Yeah, thanks for the opportunity and congrats on a sequential growth. So first question again in terms of the pricing environment. So if I'm right, last quarter we had indicated that there had been aggressive pricing by the competition because of the advantage of raw material inventory that the European players had. Now, supposedly that advantage would have been vanished. So are these European players are also increasing the prices, and will that make sure that we also take accordingly the price increases in Q4 and going forward? Thank you.
Sir, so we are waiting to see how the reaction takes place on some of the pricing, etc. But we are hoping that the pricing would increase. But we have been going ahead with some of the price increases. We have been passing on those increases.
Right. But are we seeing price increases by the competitors as well, given the probably environment where the input cost inflation is still high?
Yes, so we are seeing some increases. Yes.
Right. Thanks. So second question is, we have mentioned capacity utilization at 80%, and last quarter we had mentioned the same number at 60%. So is this 80% based on the 9-month Capex of 160 crores, or is it excluding the Capex for probably last couple of quarters?
So this particular capacity, what we have reported is excluding this 160 crores, because this particular Capex, what we have mentioned, has been majorly got capitalized in the Q3.
Right, got it. And one just last clarification. I understand that we have engaged a few consultants for various initiatives. If you can bifurcate how much is the recurring cost probably from those consultancy fees on a yearly basis, or probably one-time costs which are currently embedded and probably will subside going forward? Thank you.
Sir, we are unable to hear you. Mr. Rathi, can you hear us?
Yes. Sir, obviously it's a little bit, we have legal confidentiality agreements to talk about this piece, but we see these costs tapering down and tapering down now.
Sure, that's helpful, sir. Thanks a lot and best of luck, sir.
Thank you.
Thank you. The next question is from the line of Dhavan Shah from ICICI Securities. Please go ahead.
Yeah, thanks for the opportunity, sir. So I have a question, related to the volume and realization growth. So based on the the Q2 presentation, I think it was mentioned that 60% utilization, and right now it's been moved up to around 80%. So it means that the volume growth should be around 33% on quarter-on-quarter. Whereas if I look at the pigment revenue growth, it is around 25%. So, and also, if I look at the specialty, non-specialty revenue mix, it is almost the same on quarter-on-quarter basis. So was there any price decline? I think it should not be just because of the changes in product mix. So is that the understanding correct? If you can share thoughts on that. And the pricing decline comes to around 8% on quarter-on-quarter basis.
So hi Nilkant here. So there has not been a price decline, correct, in terms of realization. If you are comparing the Q2 and Q3 numbers, there is certain portion wherein our inventory in the finished goods we have increased considering the fast moving SKUs and our demand projection. So this particular number what you are looking at is on the product mix.
But sir, if I look at the product mix between specialty non-specialty, I think the specialty was constituting around 67% in Q2. The same is the contribution in Q3 as well, right? So there should not be the product mix changes, variance in the realization growth or degrowth. So I am unable to understand the mix, because I think if the utilization has been improved, it means that the volume should have grown by around 30% on quarter-on-quarter. Plus, if we look at the gross margin, it is dipped by around 180 basis point on quarter-on-quarter. So, because if I look at the most of the raw material may have remained stable in the last quarter because the crude was almost in the range, right? So I think it should not. I mean, it should not be the cost inflation, and we also have passed on some price during this quarter. So I think that should be reflected in the gross margins for Q3, but it is not the case.
Sir, it's a little difficult to understand your question. Is it okay to take it offline with you, because we're not able to understand your calculation? So we could discuss this, because it'll take up too much everyone's time. Because fine, yeah. Okay.
Thank you. Participants, you may press star and 1 to answer question. The next question is from the line of Kunal from Valum Capital Advisors. Please go ahead.
So thank you very much for the opportunity. I wanted to understand firstly, when I look at the slide in your presentation where you mention the progress of the Capex and how much revenue you expect for the next 3 to 4 years, I observed that we have mentioned this quarter in the presentation. We have mentioned 1,500 crores revenue to be realized from the new Capex over 3 years. And in the previous presentation, when I look at the same slide, it is mentioned around 1,200 crores revenue over 3 to 4 years. So maybe I may be wrong interpreting this, but I mean there is a slight bit of positive I would say improvement in what you are expecting from this new Capex. So just wanted to understand is there any change in the outlook?
There are two parts to it, sir. In our original, when we had shown 1 year ago, the 1,200 crore included some backward integration and also some more infrastructure projects. And also some of the prices had increased, and that's where we were giving a fair representation of this. So two reasons for the 1,500 crore changes. One is the mix of our investments has changed, and some prices have improved. That's how we.
Understood, sir. And sir, I wanted to understand regarding the projects which you commissioned in FY20 and then FY21. So are the products associated with all those projects now at least are all the products in that basket fully commercialized? I mean, I'm sure so just want to understand the status of that. So is there a certain product? Yeah.
Yes, sir. And most of these products were either these were not, one or two were completely new products. Otherwise, they were extension of the same line.
Okay, so if you say that all the products right now are either they have ramped up to a good extent, or they are at least in the process of being ramped up to the required capacity. That would be right way to look at it regarding
like we said, sir, it would take 3 years for the full capacity ramp up. So so we are at that. We are at the planned rate.
Got it. And just lastly, regarding the projects you commissioned this year in FY22, the 150 crore capitalized this in the first 3 quarters. Could you tell me the status on that one also, regarding the ramp up and everything?
Can you repeat your question, sir?
Yeah, regarding the projects which are commissioned this year in the first 3 quarters, could you tell me where those products are? Are those products commercially launched, or is it still there in the progress and we going to do it in Q4?
So unless they're commercially launched, we don't put to use. So all products which get commercially launched, only then we put the capex to use. Yeah.
Got it.
And to answer you on the ramp up, as we already mentioned in our earlier call, so we expect this to ramp up in 3 years period to the full capacity.
Understood. Just one small question. Last year for the same quarter, could you tell me what was the aggregate company level utilization capacity wise? I mean, was it the same around 80% or was it different?
You'll have to check, sir. You'll have to check this. Yeah.
Sure, no problem. Thank you very much for these answers. Thank you.
Thank you. The next question is from the line of Rajesh Kothari from Alpha Credit Advisors. Please go ahead.
Good afternoon, sir. Thanks for providing an opportunity. Sir, my first question is with reference to slide number 13. If I refer to that slide, second quarter revenue was 448, third quarter revenue is 560. So revenue is increased. At the same time, you mentioned that even second quarter conference. Yeah. So your revenue is increased. Your capacity utilization therefore is improved. That means operating leverage also kicks in. Your product mix, there is no change. If I look at the below slide, the specialty versus non-specialty, there is no change in product mix. You also mentioned at the end of second quarter that you are in the process of passing on the higher raw material cost inflation. So it means there was some price increase as well. But if I look at your gross margins have reduced from 43.5 to 41.6. And I think everybody is trying to figure it out that why it is reduction in gross margins, even in the previous participants' questions. May I request you to please throw some light on a little bit more detail to understand what exactly is happening? Is it that the competitor has basically pricing environment is so aggressive that you have to take price cut, or is it something else? Can you please explain?
So, as I mentioned, sir, that we have been focusing on passing on the absolute increases. And when you pass on the absolute increases, the percentage does not get increased to the same level, right?
Yes.
That's the reason.
So are you trying to say that when you are doing the change, percentage increase requirement was different, whereas what you passed on was lesser than even compared to 2Q? Because at the end of 2Q presentation, conference call, which happened probably, July, you mentioned that from here the environment is likely to improve because you mentioned that you are in the process of taking the price hikes. Higher the price hikes, it means your gross margins probably would improve rather than decline. But your gross margins have declined, and that's why there is a.
That's what I'm saying. So supposing you have to pass on 15 rupees, right? So 15 rupees. So generally in percentage terms, if you have to do 115, if your base price is 100 and if you have to pass on 15, you have to increase more than 15% to maintain your percentage, right? So
sure.
We have been the whole industry has been focusing on passing on the absolute increases because passing on the percentage increases would mean that we would have to pass on 22 rupees, right?
I understand.
So that's the reason, that was one reason. And as I mentioned, we have been seeing increases even after that. Our prediction was that the cost increase will not happen anymore, but we have been seeing increases even after that. But the main reason where you're seeing the percentage is mainly the absolute pass on.
Understood. So as you move forward, you mentioned that specialty chemical has 50% higher profitability compared to non-specialty. However, if I look at 2 years trend, 3 years trend, of course our Ebitda margins have not demonstrated the same. It means probably the non-specialty margins have reduced significantly because your specialty is now already 33% of your 67% compared to non-specialty is only 33%. So as you move forward and as your new Capex comes on stream, do you see, because the Capex takes time to get the peak utilization, as you rightly mentioned, it takes 3 to 4 years, do you see further cost pressure because Capex comes on stream, but it takes time for utilization ramp up? So that is first question. Second question is, considering that you might be entering into the number of new products where competitors are already present, to take market share in the initial stages, would you be a little bit more aggressive, maybe for 1 to 2.5 years? And therefore, final impact of this, therefore in Ebitda margin, we may not see much improvement. That's what you are trying to probably interpret.
See, I think firstly, let me clarify what I said on the margin difference, right? Where what I'm saying is, if my margins on the non-specialty products is let's say 10%, then my margins on the specialty would be 15%. That's the delta, right? So secondly, sir, I would not draw long-term conclusions based on a very highly volatile inflammatory market, right? Given the current conditions, these are not normal conditions where anyone in the chemical industry would have seen, where almost all raw materials are at a high. You are dealing with COVID situations where there are cycles which cycles where the demand is fluctuating. You have logistics issues, etc. So from that perspective, I would not draw any long-term conclusions saying that how our Ebitda is going to change, etc. Our product mix would be gradually changing towards a good mix, a good healthy mix, and we do expect a gradual improvement in our gross.
Thank you. Rajesh Kothari, I'll request you to come back in the question queue for a follow-up question. I request all the participants, please restrict to 2 questions per participant. If time permits, please come back in the question queue for a follow-up question. The next participant is Dhruv from HDFC Asset Management. Please go ahead.
Yes, sir. Thank you so much. Sir, this question is probably a bit related to the earlier one. So we have seen this margin volatility largely in the gross margin level, a bit understandable given the RM fluctuations that you mentioned. But sir, from a broader structural level, I was just trying to understand the people that you consider as the good competitors to you. Would they be very different versus in terms of the structure that you have, probably in terms of backward integration or something else, that if, say, for instance, tomorrow the inflation environment remains high, they get to benefit out of this inflation environment versus, say, for example, you. So the point is, today what we are seeing is because probably some people have the old stock inventory, low-cost inventory, and they are able to price their product better. Probably, as you probably are indicating, probably we are not able to do that because probably we have the higher cost inventory. So, but once everything normalizes and stabilizes even at a higher level, do we have a disadvantage versus probably some of the people that you consider as good competitors to you?
No, sir, I wouldn't. I don't consider any.
I mean, in terms of the structure that they are more backward integrated, we are less. I'm just trying to understand because historically our margins have been that 15 to 16% or probably 15 to 17%. So I'm just wondering, once everything normalizes, should we be considering something differently?
So, Nilkant here. So when we are talking about margin 15, 17, it is raw material volatility and overall cost inflation is high, our endeavor is to, one is to protect the volume, second is improve on the margin to the extent given the price cost increases and pass on. We expect that once this particular, the disruption period is normalized and we see the normalization coming back, we expect that we will be coming back to this particular margin which we had seen in the past year. And once the scale up of the new capex will start, directionally it should take a couple of basis higher also. So this is what we look at.
Got it. So basically, just to so this also means that in terms of the structuring, there is not much difference. So there is no reason to think that the margins will be different versus what in a normal scenario they should be.
As of now, yes, Dhruv. And second point is, as Mr. Rathi mentioned about, there was a question on the backward integration, and we mentioned that there are a couple of, pilot completed successfully, and we are in the process. Once, if we get the approval and we get into that backward integration, then it will give us structurally slightly more advantage. But that is in the future. As of now, there is no approval.
Got it.
But with the current structure, we see once the normalization is there, directionally we should get the benefit.
Right, so that's helpful. And so one small question is, we have seen the debt has increased on a YOY basis, but the interest cost remains largely flat, and that too, from a quarter-on-quarter last year basis. Is there, because of the capitalization that is happening in hence, and once that also, that there should be an increase there?
So, Dhruv, yes, correct observation. So, on the interest cost, two factors. One is, for the long-term loans, we have been borrowing, in the ECBs, and till the time we put to use the project, in terms of the capitalization, we capitalize. Second part to it is in terms of the working capital loan, wherein our treasury has done a great job in terms of, getting the better pricing in the market, wherein the pricing was, we got a very aggressive pricing, and we are able to get that benefit. We continue to monitor this, finance cost.
Got it. So the interest capitalization is remaining only for that remaining capex of, say, about 140 crores. Otherwise, that 160 crores is already capitalized.
Yeah. So going forward, it will be only for that. And as we mentioned, that majority of this part of the capitalization has happened in Q3. So a slight, kind of couple of, last incremental cost will come in the next quarter for the projects which we have put to use in this quarter.
Got it. Perfect, sir. Thank you so much, and all the best.
Thank you, Dhruv. Thanks.
Thank you. The next question is from the line of Abhijit Sinha from Pi Square Investments. Please go ahead.
Hello, sir. Just wanted to understand. Earlier, we were looking at about a 400 crore capex, and now we've reduced that to about 300. So, what would be the reason? I think you mentioned about COVID, but exactly what was the disruption in the plan?
As we mentioned, we put to use only after the products are fully commercialized. So, a couple of products we expect commercializations slightly to be delayed, which will run into Q1. Some of our equipment which we were to also receive for this got slightly delayed.
So, would that remain 100 crore capex, or like what do we have in mind, sir, for the 23? Because I know you just mentioned that it depends on when the entire team board decides what the FY23 plan is. But if I look into just the Q1 spillage, what would that be?
The spillage, as we said, spillage is about 100 crores.
No, we don't expect it beyond. So whatever we have mentioned, as of now, there is a reasonable certainty that we will be able to complete the plan.
Perfect, sir. Sir, you also mentioned that about 600 crores out of the 1,500 are from the, super products that we have made, and the rest would be, the ones which are already there, or, some innovation over in those segments. So, would that be included in that 600? Would it be included in the FY20 and the 21 capex that we have already done, or is it still in the one which is due? Like about 140 crores is due this year, and then another 100 in next quarter.
Majority would be coming now, sir.
Okay, sir. So, sir, also I understand completely that because of the whole logistics have increased, the costs have increased substantially. So if it was a normal situation in terms of the logistics, how much money would we have saved comparatively, sir, according to you guys? Because I think in the last quarter with the plant being shut down also due to the flood, I think that was one of our worst quarters. But this quarter, it's still hurting our profitability as per se.
So I think this quarter our EBITDA has been back almost to normal at the absolute.
Correct. It's about 12%, but sir, in Q1 we still had a 13%. So we're still impacted by 100 basis points.
Yeah. So
it is a great effort to come back.
Yeah. So from a cost perspective, it's not just the logistic cost, it's as the energy cost has gone up substantially, as we mentioned, the logistics cost, and of course, other than that, the raw material cost. These are the cost factors which are obviously weighing very heavily, especially the energy cost also weighing heavily on the EBITDA. Yeah.
Okay. So, sir, can we quantify that? How much we might have, compared to a normal scenario, how much we had to pay extra in terms of the energy, in terms of the logistics, in terms of all these things?
So, Nilkanth here, as we mentioned earlier, that in terms of the coal price inflation, we have seen 150% increases in the coal prices across, as well as in the logistic cost, we have seen 2 to 3 times increase because that has been, mentioned in the available reports.
Okay. Perfectly fine. All right. Thank you.
Thank you.
Thank you. The next question is from the line of Yuvan Gupta from Edelweiss Financial Service. Please go ahead.
Yeah, hi, sir. Good evening. Sir, a couple of questions. First is on this rising input cost. You have mentioned that the logistics challenges continues and raw material prices are still rising, though you have taken some absolute price increases but may not be sufficient enough. So you see that even for the current environment and the current quarter also there is likely to be the margin pressure. And then what happens when the raw material prices will start declining? So you have to once again immediately reduce the pricing to the customers, or large part of the benefit you would have been able to retain.
So generally, there is a this is cycle, like there is a lag in passing on increases. There is a little bit of lag on that, but that's a very short-term gain.
So you're saying that as soon as the raw material prices will start softening, immediately that this benefit also has to be passed on to the customers, and even with a faster impact. So the lag even will be there will be hardly any lag in when the prices are declining.
So, like we say that there's a quarter, we take a quarter lag in the increases. There will be a similar quarter lag.
Okay, it is the same, but you won't be able to retain the price increase. You have to pass it on.
Yes, absolutely.
Yes.
Okay. Sir, out of the 750 crore capex, hardly 100 crore rupees has been spilled over, probably to the next year, and all the capex is almost completed now, where you have mentioned roughly 1,500 crore rupees kind of turnover potential. What is after that? Over next 2 years, the focus is more on digesting this capex, or you have further growth plan and are going to going to spend some more money in the capex over the next 2 to 3 years. So what is the next 2 to 3 years capex plans?
So, like we were saying, by this financial year, most of our capex will get into it. There will be some spillover into Q1. I think with this, we have sufficient room for our growth to kind of do the growth. The only thing, like I said, the board would be closely looking at is any backward integration capexes, which we would do. But those will be small in number. That will be a small number.
So annual capex for, over next 2 to 3 years would be more than probably 50 to 100 crore rupees, right?
Yes. It will be normally a run Capex, what we mentioned. So, as Mr. Raji mentioned earlier, he's talking about new Capexes. He's not talking about the runover, right? I think you're referring to the new Capexes.
Yes. Yeah, exactly.
Capexes, like I said, I wouldn't, the board approves them, so I would not be able to tell you, but it would not be major Capexes. I can tell you that.
So the cash flow generation will be used for the debt reduction going forward over next 2 to 3 years?
Yeah. So, yes, sir. So whatever free cash flow will get generated over the next 2-3 years based on this capacity ramp up in the due to the new project will be used for the debt reduction.
Okay. Thank you, sir. That's all my side. Thank you.
Thank you. I request to all the participants, please restrict to 2 questions per participant. The next question is from the line of Ramar Mora from Alpha Advisors. Please go ahead.
Hi, sir. This is Amar here from Alpha Accurate. Thanks a lot for the opportunity. Couple of questions from my side. Sir, firstly, can you just give us some understanding about this new revenue of 1,500 crores, let's say in 3 years, how the mix would be for the specialty versus non-specialty into this part of the revenue? Hello? Am I audible?
Yes. Just a second.
Yeah.
Because the majority will be specialized, sir.
So, like, sir, current mix of your specialty is, let's say, 70-30. Will it be same or it would be like 90-20, 90-10 or kind of thing?
Sir, I think we'll look at the projection of this, but like I said, the incremental capex will be majorly, I would say, 80% towards specialized. 80%.
Okay. And secondly, sir, we had seen around about 150 basis point expansion in the margin, sequential margin improvement in third quarter. You broadly done majority of the price hike and many of your year-end client negotiation would be completed in December. So should we see a similar kind of margin expansion in Q4 as well? Something around 150 basis point? Hello?
So what we expect is based on this price, pass on. Like normally we do the price, and normally there is a quarterly reset which happens in January. So with
correct.
What we are expecting that we will be able to better it, provided there are no further shocks in the raw materials. So we are continue to watch this particular scenario. We expect that this percentage what we have reported in Q3, we should be able to do it better.
Sir, actually, yes. And sir, in terms of your RM, if you can give us 2-3 RMs which is basically haunting you in terms of your margin.
So right now, every RM is haunting us, sir.
So, but broadly, sir, like 40-50% of your contribution would be.
Right from caustic soda to nitric acid, everything is haunting, even the basic things. Packing material also. Yeah. So, sir, if you really see this kind of, inflation, this raw material has been across all the categories. Like we have seen this kind of inflation across. It is like length and breadth, correct? Wherein it has covered entire raw material basket. So, like right now we are monitoring this, and this has been, extraordinary for us to, work on.
Good. Thank you, sir. Thanks a lot for the opportunity.
Thank you very much. I now hand the conference over to Mr. Archit Joshi for closing comments.
Thanks a lot, Rajesh ji, for giving us the opportunity again. And if you have any closing comments to make, please feel free to do so. Thank you. Thanks once again.